Hey everyone. I typically will always draw yesterday's low and yesterday's high. Now, if the day is pretty big, sometimes I'll draw a major swing point. And coming into the day, I thought we were going to try and get above this major lower high because on the 60-minute chart, and I still think we will, but the 60-minute chart, we've been selling off repeatedly. We have maybe a wedge. I thought it was reasonable to expect that the market would pull back and get above a major swing point. In other words, leg one, pull back, leg two. And before I go into the daily chart and everything, these days are always kind of, I won't say tough, but what they can be frustrating because you look at the 60-minute charts, 15. You look at this 60-minute chart and you say that's a pretty strong first leg, probably a pullback and then a second leg likely. But the problem with it is you get the second leg on bar 78. So this target, the odds are it's going to get filled. Or let me back up. This price level 43.90 is probably going to get tested. And the bulls who bought here betting on a measured move, the reality is they're probably going to make money. However, it forces traders, even the traders that bought and they got out somewhere in here, if they bought bar 69, they're buying so late in the day that it's going to be really hard to hold all the way here. Just think about it. You bought above 69, price goes sideways. You finally get the upside breakout on 78, and then you have 3 bars left in the day. It's really hard to do that unless you're willing to trade into the overnight session. And obviously on the Emini, you can just buy and stay long. But a lot of traders don't want to do that. They want to take their profit, which makes a lot of traders less willing to trade for the second leg. And another thing I want to say, this is pretty classic kind of trap pattern. The sell off to 68, it's a bear breakout below a triangle right here. And the problem with it is you had a pretty strong bull breakout earlier in the day. Several ways you can draw the triangle. I'm just going to draw it so that we know it's there. But all these bears that sold above 19 during 20, they got trapped and they got trapped in a big way. And because of that, a lot of those traders down here are not willing to sell again. So let's go to the daily chart. On the daily chart, I've been saying on the blogs that the bulls want a second leg trap, the bears want a strong enough breakout for a second leg. I think the problem, this is a little bit problematic for the bears. If I'm a swing trader, if I'm an always in bear, let's go to the Globex session. If I'm an always in bear and I look at this, and the reason why I flipped to the Globex is there's no gaps. You should trade gaps and think about gaps as breakouts, but sometimes it's easier to visualize the breakout and actually see the breakout. But in any regard, bull bar, probably sellers above, and strong enough breakout, first slope would be minor. But again, the problem is we still, I suspect a lot of bears are disappointed by this bull bar. And because of that, think about it like this. Let's go to a 60-minute chart. No, let's go to 240. Here we go. When you look at this chart, and what I'm trying to do, the reason why I'm changing my time frames is I'm trying to explain, I'm trying to better represent what, we'll just go to 200. I'm trying to better represent what that bull bar looks like. That bull bar on the daily chart is a breakout on smaller time frames. And because of that, there's probably buyers below and at least a small second leg up. So if we go back to the daily chart, what that means is the bears that are selling the close of this bar, it's not really an ideal thing to do. And the reason it's not ideal is because if you're selling the close of this bar, what can you realistically expect? In essence, you're selling a setup that's probably going to lead to a low one short. Most low ones after buy climaxes, most low ones fail and they lead to deeper pullbacks. Here's a low one and it's a bear bar. And look what happened. Price went higher. So this bear bar right here, it's kind of the same logic. You have consecutive bull bars, then you get a bear bar. And instead of selling the close, a lot of traders bought the close betting on a second leg. So I think you have a lot of bulls here who think there's going to be a second leg up. And some bulls, the really aggressive bulls, they might buy above this bar. And let's visualize it on a Globex chart so it's easier. They might buy above this bar. And let's say it triggers. And let's pretend that it's a computer or it's an institutional trader and they can watch, let's say they can actually watch the market, 24 hours a day. They're going to buy above this bar when it triggers. And if the market doesn't race up rather quickly within a reasonable period of time, if this bar is, let's say 23 hours, because it's obviously closed for about an hour. But if this bar triggers and takes too long to go up, you'll have more and more traders reducing their position. Kind of like right here, bad signal bar, bulls bought it. And the entry bar was okay, but not great. And as the bar went higher on this bear bar right here, August 22nd, a lot of traders started to sell out of their longs, scalping out because they were anticipating disappointment. And that's what led to all of this. So, what do I think is going to happen on the daily chart? I think it's reasonable. Two things I think is going to happen. I think the bears will get a second leg. However, they may get a delayed second leg, and I'll explain that in a second. The other thing that I think is going to happen is I think the bulls who bought any of these lows, and even the bulls who bought here around 44.80, those bulls are probably going to make money. Now, what's the probability that we trigger the sell above today's high and we immediately go outside down? To me, I think it's low probability. The reality is if we go to a weekly chart, let's go to a monthly chart just to really think through it. Here's the monthly chart. And look what happened at this price level. Traders bought it. Now, ultimately, we could easily test 4,200 and any of these breakout points. We could test the low of June 30th of 2023. And I think we will at some point. But the reality is, I think the bulls who buy here and they just scale in lower, they're going to make money. And as far as traders, the bears getting a second leg, it could be like this. So we had a rally up to 22, and then we had a side. We basically had several hours. This is 11:30 Eastern time, all the way to 1500. So that's about a little more than 5 hours of sideways trading, and then we got a second leg, and that's exactly what could happen on the. That's exactly what will probably happen on the daily chart. So, in other words, big sell off, probably sellers above, and a second leg down. First bar of the day is a big bear bar. And for one, whenever you have a big bear bar, you always hear me say in the blogs 20% chance that bar one is going to lead to the extreme of the day. In other words, 20% chance bar one in this context will be a bear trend from the open. 80% chance bar one will be either it will either lead to a double top or double bottom or wedge top or wedge bottom. In other words, 80% chance you're going to get a trading range open. And because of that, one of my defaults when I'm trading on really any open that has a clear open and a clear close is I'm always assuming the Emini is going to form a trading range on the open. So even when I see this, I'm a little bit suspicious. Good trend from the open, good bull trend from the open, but the reality is it's probably going to be a trading range, which means there's an 80% chance of a minor reversal that leads to sideways trading. So this is actually pretty high probability of what to expect. Plus, we rallied and we couldn't break above the moving average. So bear bar, and then bar two is a bull bar. If you understand the context of the daily chart, it's reasonable to assume that today was not going to close above yesterday's low, which was Friday. So we gapped down below yesterday. Reasonable to assume we're going to find profit taking. Strong rally last Friday, big sell off, and then we gapped down. We're probably going to the close of yesterday, which makes bar two a reasonable swing buy. Bar two is an inside bar, possible final flag, and there might be sellers above two, but I think it's a reasonable swing. And then three, decent entry bar, testing the 77 low. Are there buyers or sellers? To me, it's consecutive bull bars, 2 and 3, and it's probably reasonable by the close. So I think it's always in long. You can buy the close of 3, and you can put a stop below 2. But big tail on 3, that's a warning that something is not quite right. 4, 3 consecutive bull bars, but a bigger tail on 4 and more of a doji. Profit taking at the 77 low. Still probably buyers below 4 and buyers back at the 1 high. The bears, they sold the 1 high during 3, scaling in higher, possibly selling at the 77 low of last Friday, the blue line. Those traders are probably disappointed enough that they will look to buy back shorts back at the 1 high, and bulls will look to buy at the 1 high. It would also be around the entry price for the bar 2 bulls that bought above. Bar 5, a bull bar, but you can argue it's buy the close ever since 3. But 4 is a doji, and whenever you get a buy the close rally and you get a doji like 4, it's usually a warning that the market is not going to go that much higher. And then bar 6, we have another bull bar. But look what happened on 6. Look at the moving average, the blue line, and the close of bar 6. The market failed to break far above the moving average. And the reality is, you can say it's always in long and it's a bull trend from the open, and that's all true. But because in general on the open, 50% chance any rally or sell off on the open is a buy vacuum or a sell vacuum, you have to respect the possibility that we have a gap down from yesterday's 81 and the low of today, yesterday being last Friday. And the rally up to bar 6 might be a pullback, and the bears could get a second leg down. Plus, bar 1's a bear bar, and we could easily test that breakout point. And when you look at the rally up to bar 6, there's a lot of overlapping bars. 3 is a strong bull bar, but look at 4 and look at 5. 4 is overlapping a lot of the prior bar. 5 overlaps a lot of 4, and then 6, good bull bar, but a big tail. It'd be better for the bulls if they could break far above the moving average and stabilize. And then you see 7. As soon as we touch the moving average, traders hit sell the market. For the bears, they can argue a possible parabolic wedge with 1, 4, and 6, but it's probably a minor reversal. Typically, when you have a wedge and you can draw it and it's within a micro channel, we have a bull micro channel up to bar 6. Usually, the best the bears will get is 2 legs sideways to down. Bar 7 is a big enough bar that the bulls who bought the close of 6 or below 6 are probably disappointed. And because of that, the bears will probably get a second leg down after any pullback, which means there might be more sellers above 8 than buyers. Bar 8, consecutive bear bars. More bulls will exit on a test of the 6 high. And then you can see 9, we broke to the upside and it's testing the 6 close. If you're a bull and you bought the 6 close and then you see a bear breakout 7 below 6 and then follow through on 8, you're going to be disappointed enough that you might be willing to sell out of your longs back at the 6 close. And that's what happened on bar 10. 10 almost outside down, second entry short for the bulls, and a second failed breakout of it's a second attempt to break below yesterday's low. For the bears, it's a reasonable swing short, although it's aggressive, betting that we have a failed breakout on bar 6 and a double top with 6 and 10, and betting that we'll test the 1 high or the 2 high. However, if you're selling below 10, you're selling low in a tight trading range that will likely evolve into a bull flag. So whenever I take a sell, if I'm ever selling below bar 10, I know it's a low probability sell. We have a lot of bull bars. We're probably always in long. And because of the context on the higher time frames right here, it's reasonable to assume that we get a higher low and a second leg up. So this might be leg 1, complex pullback lasting 6 or 12 bars, and then a leg 2. And then bar 11. 11 is one of those interesting examples where I often mention how you can there's a lot of stop entries. I often mention that it's pretty frequent for stop entries to not immediately fail. And that's the reason is the market's for the most part 50-50. So if you sell below bar 10, and then you see 11, and you know 10 is a low probability sell. It's a big bar with big risk and not the best context in the world. If you're selling below 10 and 11 is your follow through, a lot of traders will be quicker to get out. And then 12, let me fix the numbers. And then 12 is a bear bar, but look at the close of 12. 12 failed to close, 12 closed below 11. However, it did not close on its low. It's also testing the 2 high, right where the bears got trapped. The bears sold above 2, they sold above 1. They scaled on higher. A lot of those bears will buy back shorts at the 1 high in the 2, in the 2 high, which means 12 might be a better buy the close bar than a sell the close bar, even though it's not a great buy signal above 12, which means there might be more sellers above 12. I suspect the market is going to try and stabilize and go sideways here. 13, surprise, bull bar, closing on its high, but following 3 consecutive bear bars, there might be more sellers above 13 than buyers, and we may need a retest of the 12 close. We sold off down to the 12 low. We pulled back on 13. It's a trend line break, sell off, trend line break, and we may have to test somewhere down here before the bulls buy again. Also, 13 is a really big bar, and big bars lead to big risk. It's a better 13 is a better buy than 9, but if you buy above 13 or the close of 13, you could easily get a pullback all the way to the open of 13, close of 12. And then you can see 14 is a bad entry bar. We failed to trigger the buy above 13, so it's an inside bar. For the bears, they're hoping that 13 is a complex two-legged pullback on a smaller time frame. We sold off to the 12 low, we rallied to the 13 high, we pulled back on the close of 13, and then we rallied and pulled back during 14. So on a smaller time frame, that could be some sort of second entry sell. And then 15 is a bear bar triggering the sell below 14, but 14 is a bad stop entry short. I'm going to make the bars a little bit bigger to try and fix the bar counter. 16, a bull bar, second leg up after 13 and 14. But if you bought the close of 13 or 14, you're disappointed with 15 and 16, and therefore a lot of traders might be quick to get out. And then 17, a surprise bear breakout. Are traders going to sell the close of 17, betting on lower prices? Some will. Some will sell it, hoping that 17 is a bear breakout below a tight trading range. Or you can call it a bear breakout below a triangle, and that will test the open and the close of bar 1. However, and I forgot to mention 12. 12 was a test of the open at 48.25. However, it came within 2 ticks, and that might not be enough to satisfy the test. The market may have to go 1 or 2 ticks below 12. But in any regard, the traders selling below 17, they don't have follow through. So if 18 is a big bull bar, a lot of those bears will get out. And instead, 18 is follow through. Consecutive bear bars, 17, 18. Is it always in short? I think it is. But look at the context of the day. Trading range days, it's typically a bad idea to sell after you've had 2 legs down or buy after you've had 2 legs up. We have an obvious first leg down to the 12 low. And then we have a pullback up to 16 and a second leg down, 17 and 18. So if you're a bear and you're selling the 18 close, it's the same thing. If you get a bull bar closing on its high, I think a lot of traders would be quick to get out. And then 19 is a bull bar. What about selling above 19? What about selling above 19, betting on a second leg down? For me, I think that's a low probability sell. In general, it's better to look to whenever you get a second leg down in a trading range, it's typically better not to scale in, and it makes more sense to just take the loss. So for me, had I sold below 18 or had I sold below 10 and held through this, I'm going to get out of shorts above this bar. Too much risk. It's a second leg trap. Leg 1, pull back leg 2, and we get a complex second leg up. Rally, pullback, maybe 12 or 18. and then we get a second leg up to here. And then we got a surprise bull bar on 20. For the bears, if I was short above 19 and I did not get out of shorts, I would certainly exit shorts on the close of 20. 20 is such a big bar that it's really dangerous to be selling as that bar is going up. However, 20 is also a big bar, and climactic bars usually lead to sideways trading. 20 is a big enough bar that the reality is we'll probably get some kind of measured move up. For the bulls, they hope it's a double bottom, 12 and 19. We break above the neckline, bar 6, and go for a measured move. And then 21, a weak bull bar for the entry bar or follow through. It's not a bear bar, so it means that's good for the bulls. It's at least follow through buying, but it's not as strong as it could be, and that will lower the probability for the bulls. However, the reality is if you're a bear, it doesn't make a lot of sense to sell below 21. And if 21 is a bad sell below the bar, that means 21 makes more sense to buy the close. And that's why 22 looks the way it did. You had some traders who were hoping this was a trap, trapping bulls into buying high in a trading range. And they wanted 23, excuse me, they wanted bar 22. 21 is this bar. They wanted 22. I apologize. Let me back up. Bar 20 is a big bull bar. You had some bears selling the close of 20, hoping that 21 would be a big bear reversal bar, trapping bulls into buying high. And instead, 21 was a weak follow through bar. And because of that, it increased the odds of a second leg. And then 22, strong bull breakout. Strong enough bull bar, probably buy the close and going higher. May go for a measured move. The open of 20, close of 22. So may get a measured move up. But we had a lot of disappointment here. And we had a big sell off here. And you're right in that area where bulls got trapped. Bulls got trapped buying 73 or 74 last Friday. And we're testing into that zone. It was reasonable to think that this rally on 67, 68 would get a second leg up. And instead, we got a strong bear breakout. So you have all these traders that are trapped in here. And if they're trapped, what do you think they're going to do when the market retests this price level? They're going to look to sell. And that's why as we started going up, you had more traders selling. Bear bar 24, is it a sell the close bar? Would you sell below it? I would not. For me, it's two legs down. We sold off on 23, pulled back, sold off on 24, and the odds are we'll at least go one tick above the high of 22. Some bulls that bought the 22 close, they were disappointed with the entry bar 23. That as soon as 23 closed, a lot of traders tried to sell out of longs at the 22 close, and the market sold off on 24. You can see the close of 22 is 71 and a quarter, and the high of 24 is 71 and a quarter. Bull bar 25, high one buy, but it could also be an implied two legs down on a smaller time frame because of the tail on 23. Any regard, there might be sellers above 25, but to me, I think it's better to be buying and using a wide stop than selling. Bear bar on 26, second leg down after 24. The bears, you had bears selling above 25 here at 69 even. They got filled 69 and a quarter on bar 26. And I suspect a lot of those bears are just trying to get whatever they can get. So if the size of this bar is, let's say it's almost 4 points, it's really probably 3.5 points. You have some bears who will sell and maybe scalp out for 1 point. And that's why 26 sold off and 27 immediately reversed back up. The bulls, they know there's probably sellers above. So rather than buying above 25, what are they going to do? They're going to buy the midpoint of this bar or even the low of this bar, betting that the bears who sold above 25 are going to buy back their shorts. 27, a little bit of a surprise, but it's a second leg up after the rally, the surprise breakout up to 22. 22 is a major surprise. And because of that, it'll probably influence the market for the rest of the day. And the reality is the bears are gonna have a hard time getting a downside breakout for probably several bars. 28, a bear inside bar. Probably buyers below. Second entry is short, but probably a minor reversal. Only 4 bars down and 1 bar up. Not enough for a major reversal, which means we may sell off below 27, but we'll probably have buyers below. And I've got to speed up a little bit, unfortunately, because I'm running out of time. But in the future, I will make some of these videos longer again. 33, second entry buy. Through here, my expectation is when I'm trading, I'm always trying to think through what's the surprise, what's that dominant feature. And to me, it's this. So if there's anything I'm doing on this chart, my number one priority is looking for buy setups. So if I'm long and I'm scaling in and maybe I scalp out below this bar or exit longs below this bar, we get a second entry like 33. I'm buying again, taking a chance we break to the upside. And that's why bears exit on 34 and 35. 35 is a breakout above a channel and a possible wedge. 1, 2, 3. So if you get a bear bar closing on its low, especially remember the context, we're testing this area, Friday 72 to 74. That's an area where bulls got trapped. So if we get a bear bar closing on its low, a lot of bulls might exit. 36, high one buy, but in the third leg, leg 1, leg 2, leg 3. And if you've listened to Al or some of these videos, you know I've said several times buying the third leg of anything is generally a lower probability trade. 37, outside down. I would exit longs below 37 and wait to buy. Too much risk of a second leg down in a test of the 31 high or even the 31 close. Good follow through for the bears on 38. More bulls exiting. But the reality is, even if we fall below 27, this is probably all going to lead to a trading range at best for the bears. 39, inside bar, second leg down for the bears on 40. And then we tried to sell off. You can see we broke below 27 and we rallied in a big way. Whenever you get these big tails and you break far below something like 27, that big tail's buying pressure on smaller time frames, which means you had some bears who sold the low close of this bar and they got trapped as the bar went up. So what are they going to do on a pullback? They're going to buy back shorts, and that's what creates a small higher low. We sold off, we tried again, we formed a micro double bottom, and then we broke to the upside. Reasonable bar to buy, but tight bear channel. So the first reversal up could be minor, which means strong bull bar, okay buy, follow through, not as strong as the prior bar. So it would have been better if 45 looked like 44, but because 45 is weaker, lowers the probability for the bulls. 46 inside bar, you can call it a lower high major trend reversal or a head and shoulders top, left shoulder, head on 35, sell off, and then right shoulder 45. And I said 35 and 30. I might have said 34 and 35 right here. I meant 44 and 45 when I was saying the bull breakout and how 45 should have been bigger than 44. And because it wasn't, that told traders that this is not as strong as it could be. 47, decent entry bar, but I think the Bears really need to overcome this right here. 44 and 45 is too much buying pressure, and most major trend reversals lead to sideways trading and even trend continuation patterns than trend reversal patterns. So when you see a head and shoulders top, which is a lower high major trend reversal, left shoulder, head, right shoulder, you should usually be looking for the opposite. Look for the pattern to fail and then lead to trend continuation. 48, bear breakout below 41, but you can see big tails and we have all this buying pressure here, and that might lead to a trading range. And then we went sideways for several bars. For the bulls, I don't think it makes a lot of sense to buy above here. Some more bulls will buy above here, second entry buy. And if they bought there, they probably get out of shorts below this bar. This is all a trading range. And if I'm swing trading, I like to think of it as fishing. I'm trying to catch a big fish. So if I'm buying above 52, stop below, I'm probably going to get out below that bar and then wait for another setup. If I buy again here, which I did, I'm going to get out below that bar. And in this case, I was too slow to get out below 63 or 64. And because it's a triangle, I don't want to risk a downside breakout. So for me, if I'm long, I'm getting out below 61. and I did here in 66. It's a bear breakout below a triangle. It's an okay sell to close bar, taking a chance. We plunged down, and we did on 67. But 67, 2 legs down, leg 1 sideways, leg 2, but testing pretty important support, the low of Friday, and we're testing the 21 and bar 20 breakout area. And to me, that lowers the probability for the bulls. Follow through selling, but if we get it, you can sell the close, but if you get a bull bar and a reversal up, a lot of those bears will exit. 69, surprise, in a second leg trap, bulls are buying, and we had a couple of legs sideways to up into the close. So overall, I think the best stop entry trades, I think it was good to buy above 2, but exit below one of these bear bars. And 19 made a lot of sense because if you're buying 19, remember what I talk about on the blogs? 80% chance the market will form a swing trade beginning before the end of the second hour. And that swing trade often forms before the swing trade, before the setup of the swing trade, in other words, the stop entry of that swing, often forms a double bottom or a double top or a wedge bottom or wedge top. 19, double bottom of 12. I think that's a pretty good buy. And then I thought it was okay to sell below 37, but kind of aggressive after this many bull bars. But it is the third leg, and we'll probably test the 31 low. And then if you took that sell, you probably get out a couple of points above any bar. I thought it was okay. I would not sell below 46, but I think it's okay to exit longs. And then, tough call. Do you buy above 50? To me, buying above 50 is buying relatively high. And most traders, after 3 consecutive big bear bars, would rather wait for a second entry like 52. If you buy 52, you get out below 56. If you sell below 56, you exit shorts above 61. If you buy there, you get out below any of these bars or below 61 and maybe reverse to short if you're quick enough. And then bulls buy above 69. But overall, tomorrow, I think we'll have more disappointment on the day. So I don't have time for questions today, but save your question for Wednesday. Or if you're in the trading room, feel free to tomorrow to ask me your question at some point in the day. All right. Thanks everyone for watching, and I will talk to everybody soon.